In a world where even the smallest disagreements can lead to arguments, violence, and even death, two brothers tackle the difficult subjects. This podcast is not just about dissecting topics from two different perspectives. It's also about how to have conversations on difficult topics while avoiding the urge to tear someone's head off and vomit down the bloody stump of their neck. All right, so we're following up on last week's, which is the exciting world of taxes. And where we ended things was we wanted to look at motivation, I believe it was, for I guess like looking at like encouragement. You know, why one of the points that you were making was that people are demotivated to things like investing and business because if tax rates are high. And we were also going to look at some of the unintended consequences. Is that, am I remembering correctly?
Yeah, the word I would use is incentives.
Okay.
I think motivation is related, but just as an example, if we take it to the extreme, we might say, well, if after you made $1 million, your tax rate went to 100%, there's not going to be a lot of people that are going to work after earning $100 million.
Right.
And if you dropped it to 90%, a few more people, or there's maybe some of those people, there's some more incentive. You drop it to 50%, there's more incentive. And you drop it further, and there's more incentive. At some point, there's diminishing returns, I think. So for example, you go from 12% to 11%, maybe it doesn't move the needle that much. But certainly there's an incentive and an unintended consequence when you raise the marginal tax rate for people either to not work or to look for other places to put their money.
Sure.
And then we went through, you and I were reading a little bit on Thomas Sowell's book. It's kind of a little pamphlet, Trickle Down Economics and Taxing the Rich, where he talks about certain times in our history where tax rates were reduced from those really high rates of 90% or so, and actually, collections, especially for the rich, went up. Now, we have to be careful when looking at that type of data because there's a lot of other noise in the data. For example, if you say, well, the tax rates went down, but the tax revenues went up, well, some of the time periods we were looking at were after World War II or after World War I, in the roaring 20s.
Well, that was his time frame, was right after World War I.
Correct. Right after World War I is one of the places he looked at. But once again, I think you just have to, it doesn't mean you can't look at the data at all. It just means you have to look at it carefully, meaning one of the things he looked at was the number of people that declared over $1 million of income and how quickly that increased. Just like in a couple of years, it went up quite drastically because all of a sudden people were willing to invest in something other than tax-free municipal bonds, for example, or hide their income in some way. Not to say that wealthy people would ever do that, or poor people would ever do that. I mean, obviously some would, but even if there's other ways to invest your money, you might say something like, well, the tax rates are lower in a certain area, so I'll invest there. So like tax-free municipal bonds. And I don't want to get into, exactly what the rates should be or, where the diminishing returns start. Do they start at 12% or 30% or 50%? It's going to be a difficult number to come to, especially for people that aren't looking into it with as much data as, you and I just don't have a lot of data for this, but we should at least concede that there is going to be unintended consequences and incentives at play when we have these tax rates and we have different types of taxes, right?
Yeah, I would agree with that. Yeah, and I have, when you sent me the link to, what was his name, Thomas Sowell?
Yeah.
Sowell. I found it interesting that he was really, at least in the excerpt, the pamphlet that you sent me, he was looking at 2 data points, tax rate and tax revenue. And that was really it. And I was interested because I would think right after a war, there's going to be a lot of other factors that are coming into play. You've got an economy shifting from a wartime economy to a peacetime economy. You've got an influx of both consumers and workers that are coming into play. And so there's a lot of other factors that will come in. And that was why I printed out, or I created that chart that I wanted to show you, or that I did show you. Because it looks at, in particular, let me see, where is it? This one. Another wartime, or the post-wartime economy, which is right after World War II. And the reason why it was so interesting, I mean, we'll never get an apples to apples. We'll never get, all variables to be exactly the same in both situations. But we do have two wartime, post-wartime economies. And in the one that he was using as an example after World War I, they decreased the tax rates and they found an increase in revenue. And this one right after World War II, there was no change in tax rates, but there was still an increase in revenue. And so my point really was, there's more to it than what he was putting out there. And in fact, I'm not an economist, but I feel like he was avoiding a lot of information by looking only at World War I, where it reflected a result that he was wanting to push.
Well, first off, I would say that I agree that, yeah, I mean, as I said before, you do need to look a lot more data. One point that you made that I would take issue with is he did look at many more data points than that. Two that I can think of off the top of my head were, one, he looked at the percentage of taxes paid in total by wealthy people, which went up drastically in that time frame. So it wasn't just that overall revenues went up, it was that the percentage paid by wealthy people went up. And one of the arguments that both the member of Woodrow Wilson's administration and Thomas Sowell, and later the people in JFK's administration and Ronald Reagan's administration, was it's unfair because the way, if you leave the marginal tax rates high, and by the way, marginal tax rate means, for example, if you make $1 million, the first I don't know how much, $20,000 or $30,000 are going to be almost no tax on it, or maybe no taxes on it. And then the next 30,000 is going to be like a 10% rate. And then it keeps going up after that. So marginal tax rate is the tax rate after a certain point. It's kind of the point at which the tax bracket that you're going to fall into. So if you fall in the 30% tax bracket, it's not that everything that you earn is taxed at 30%. It's graded up to that, and then everything over a certain point is taxed at that rate. But when you have high marginal tax rates for wealthy people, as they did prior to World War I, those wealthy people have all the incentive and all the means to put their income in different buckets that are not taxed very much, which puts more of the burden on poor people. So I think you and I should be in agreement on this, meaning I think when you have high marginal tax rates, there's a huge incentive for wealthy people to say, well, let's put some of my income in tax-free municipal bonds or other tax-advantaged vehicles. And they're going to be lobbying Congress, not all of them, but wealthy people have all the incentive to go to Congress and say, hey, let's set up another way for us to hide some of our income in the form of, we're going to invest in, real estate or whatever else. They're going to find some way that's appealing and that, is beneficial to the economy. Is how they're going to frame it. And there's probably some truth to it, but they can hide that income. Poor people that are making $30,000, $40,000 a year, for them to put some of their money in tax-free municipal bonds just doesn't work for them. So they bear more of the burden. When there's a high marginal tax rate, more of the overall tax burden is going to fall on poor people than when it's lower. Obviously, when I'm talking about going from 90% as the marginal tax rate to something like 50% or maybe even lower than that. But you understand what I'm saying? And that's the argument he was making. There was more points to it than just, well, all of a sudden tax revenues went up. He looked at the total share of the taxes that were paid by wealthy people as opposed to poor people, the total number of wealthy people that were declaring a certain amount of income, and it went up, by orders of magnitude. It was just incredible because all of a sudden they didn't have a reason to hide their income. I say hide, although I probably shouldn't use that word. It's somewhat negative. They're just making a wise choice. Well, am I going to get taxed at 90% in this one bucket, or am I going to get it's going to be tax-free in another bucket? Maybe I don't make as much money in total in this second bucket, but if I'm going to get taxed at 90%, who cares how much money I make if I'm going to give it all to the government, right?
Yeah, and you are correct. He did look at other points, although all the points that he was looking at were all related to the idea of the tax revenue. And my point is, he wasn't looking at things like the changing in the economy, the influx of both workers and consumers. That he didn't address at all in what he was looking at. And that's why I brought up this graph about the post-World War II, which would be a somewhat similar economy and a very different outcome based on what he was saying. Now, let me also say here, I'm not arguing for a 90% income tax bracket on anybody. I don't feel like that's fair. I think we've gone well beyond fair. I only used this chart because it was similar to what was like after World War I, both post-war periods where you had a very high tax bracket for the very wealthy. And if you then bring it down to a more reasonable number, let's say 30, 40, 50%, whatever. I guess everyone's going to have a different idea of what reasonable actually is. You're going to have probably different results. But I also want to address what you're talking about with other investment possibilities, these tax-free municipal bonds. Right now, a tax-free municipal bond is going to give you somewhere between 3 and 7% or something to that effect. The higher the return, the more risky the investment, the more likely it is that municipality is going to declare bankruptcy. A safe municipal investment right now is around 3 to 4%. It's not a huge return. And so if you consider someone looking to not pay taxes and instead look to putting their money into a municipal bond like that, in order to make the same amount of money, it's equivalent. Let's say that they were getting 50% tax, which is nothing that's being offered right now. They would have to be investing at something that invests less than 8%. Or that returns less than 8% in order to make more money in their municipal bonds while avoiding their taxes. So there's not a huge incentive if you're looking for a return on your investment. It's a very low return that you need in order to do better by investing and paying taxes than by investing in a tax-free option.
A very small difference. I'm sorry, I don't. Let's say that your return is 10%. If the government's taking, 50%, then 50% of your gain.
Mm-hmm.
That's 5%. So you're left with only 5%. So a lot of tax-free municipal bonds. Then you do have. And a lot of investments, like you're hoping for 10%, but you only get 7%. The government takes 50% of that. Now you're at a 2% return. And that's worse than a tax-free municipal bond with none of the risk, because that's a pretty good return if you know that money is going to be coming back. A 3% municipal bond or a 4% municipal bond. Yeah, I think but we could quibble about how much incentives there is for each of them. I think we should just focus on the fact that there are unintended consequences. There are incentives. Just another example of it is here in Oregon, we have no sales tax.
Right.
Which sounds great, but the income tax is really high. And then we have permits, which we don't think of as taxes. But if you want to build a house on the coast, the estimates I've been given from people that do it is it's a 40% fee total. There'd be 40% in permitting fees just to build a house. That's a massive. That's going to have a massive effect, especially on poor people. Or people that aren't making, hundreds of thousands of dollars every year, because they're going to make the smaller house. They're going to be buying the smaller houses and building the smaller houses. And so that's going to be, like a 10, 20, 30% tax for them on building a house. And I'm not saying that's right or wrong, but we sometimes forget that there are different incentives for all of these different types of things and unintended consequences. And we should always bear that in mind. And sometimes we do things that make us feel like, well, hey, this is so we can stick it to the rich, and we end up sticking it to poor people. Just as an example, I think those permitting fees, that is really disproportionately paid by poor people, because if we're all paying the $40,000, you have a $2 million house, that's a small percentage of the total. It's a small fee as a percent of the total that you're paying. But if you're building a $200,000, $300,000 house, that's going to be a quite expensive tax.
Now, are those fees you're talking about, is that only on the coastline? Because if that's true, then the obvious solution is to build inland.
No, it's not. In fact, the permit fees are more expensive as you get closer to Portland.
Closer to what?
Portland, like 2 hours inland.
Yeah.
So it's it's across the board. From what I haven't investigated every county in the state, but I talked with my friend who's done a lot of building, and he was the one that told me it's $40,000 here and closer to 60 in Portland. I imagine there are different fees all over the place. I don't know where it's highest and lowest. But yeah, I'm just illustrating the point that, you say, well, just build inland. But yeah, if you want to build on the coast, or if you have a house or if you have a job on the coast, or you have family there, you need to take care of your parents, and you have to build on the coast, there's only so much you can do there. Now, I get it. You could move someplace else. The coast is a cool area. But yeah, in Oregon, that's a tax. They call it permitting fees, but that's really a tax that is levied against people across the state. And that's going to have an effect. That's going to push up the price of housing. Sure. Another one that I think we don't pay much attention to, and it's technically not a tax, and it's not a tax at all, really, I guess, until you think about it. When, for example, it's very difficult to build high density housing, and you and I have had this conversation before.
We have.
Well, if you make high density housing very difficult to build in any area, that's going to push the price of housing up, because high density housing is going to be less expensive to build per person per capita. So when you do that, all these different regulations and things that the government does that pushes the price of housing up.
I lost you, Colin. I lost your volume. You think you hit mute.
Okay.
There we go.
How about that?
Good.
Okay, yep. We're back. And we're back. So I guess I probably shouldn't bring that stuff up. It wasn't really fair, because I don't want to, leave the impression that if we don't talk about it, that I won or something. My only point in all of this is to say there are incentives, there are unintended consequences, and we should be very careful when we talk about these policies to determine what those, sometimes unintended, but a lot of times foreseeable consequences will be. That we're going to have an effect. We're going to affect behavior when we do these things. We have to understand that. And I think that's part of why, sometimes it may seem like, there's too many tax breaks for the rich or something like that. But part of it is, that you want to incentivize certain behaviors, right?
Yeah, and actually that moves us into one of the other areas that I wanted to address in this conversation, which is one that you have brought up about motivation, about incentives. That when we overtax, and I don't want to call them wealthy. I'm going to change this focus a little bit. When we overtax the entrepreneur, the one that wants to go out and do things, to make things, to build businesses, to go and make lots of money. Your argument has been that when we overtax that person, we're creating a disincentive for them to go out and do that sort of work. And the reason why I want to make the distinction is because not everyone, if we take, let's say an executive in the movie industry, their excessive money is not really economy building. Yes, maybe they're buying fancy watches and fancy houses and fancy cars, but it's very minimal. It's a little bit different when you have someone that's going out and creating a business. And if we want to use an example, we can use the Bill Gates, the Elon Musk, the Jeff Bezos, whoever, people that have built a company. And it doesn't even have to be that big. It can be a small local business or an entrepreneur that's doing the same thing. So the argument that you and others will put forth is that they have no incentive to go out and build the business. That they're just going to sit home because they're going to be overtaxed. And I think that once many of those people, it's not so much that they're driven by the money, it's that the money is an indicator of their success. And don't take that too far, where we can tax the hell out of them because they're just driven by, they just want to prove that they can do it. But if with that sort of person that is motivated to, by the challenge and by the excitement and looking for the success, it's not so much that they're really looking to have hundreds of millions of dollars. That's a consequence. That's a result, unintended consequence, if you will, of the success that they have in their business. And I think Elon Musk is a fantastic example, who really, in his first couple businesses, was incredibly successful, but he wanted to go and do it again. And he's still creating all these companies. He's the boring company about to try and build tunnels underneath the cities. It's not so much that he's saying, I need more money now. It's that he saw a problem, he wanted to solve the problem, and it looks like he could possibly have some success with it.
Yeah, I think there's a lot of truth to that. I guess, I would agree with that stuff. But I would say a couple of things about it. One, sometimes I think it's a bit reductionist to say, well, these people, first of all, the argument I made was not just that they would sit at home and do nothing. A big part of what they would do is invest in other things, like tax-free municipal bonds, or other things that have different tax consequences. The other thing I would say is, what was the other thing? Dang it. But yeah, they are going to invest. Oh, the other thing I would say is, well, what's the alternative? If you said, let's say, for example, Elon Musk, he made, I think it was something like $80 million when he sold PayPal, and then immediately turned around and invested in Tesla, SolarCity, and SpaceX, if I'm remembering the story correctly.
Not all at once, but they were sort of in that basic order, I believe. Yeah.
I think it was kind of all at once, because all of a sudden, it maybe wasn't in the same week or month, but it was in pretty quick succession, because pretty soon after selling PayPal, he was having to live on his friends' couches, from the stories I've heard, because he had put all of his money into other businesses. But what would be the consequence? One other consequence of saying, well, he's just going to go out and do more money. But if you take $50 million of it, or $40 million of it, or whatever number, and instead give it to the government, then he's got less to invest.
Right.
And so that's a trade-off. And you might say, well, I don't mind. I want the government to have it. Okay, but that's the trade-off. You're giving some of that investable money that he would use to start businesses, create jobs, innovate, do things that are going to, there's massive ramification to that, not just the jobs that he creates in his company, but all the ancillary supporting companies, all the vendors that he's working with, the payroll company, it's creating all kinds of stuff. It's really economy building stuff that he's doing. If instead you give it to the government, who knows? Like, that may be your thing, but that's going to do more. There's more to it than just, well, these guys will just keep working. Okay, but you've taken some of their money away. You've taken away some of their dry powder, and you've incentivized them to do different things with it. Are two big things. Like, sure, maybe some of them sit home, and you're kind of being reductionist and saying, well, they care more about building something than making money. Well, some of them just care about money. Some of them are just saying, well, what's the next thing? Or some of them are 60 years old or 70 years old and thinking, well, I'm kind of done. I could do a little bit more, but not if they're going to take so much of my money. There's all kinds of people out there. It's not just one type of wealthy person. And there's not just one thing they're going to do with that money, would be my point.
Yeah, but in the same way that you're accusing me of being reductionist, you're kind of taking that same approach where that when we overtax them, they just kind of give up on the whole thing. Another argument that's often made is, well, they're gonna. What's that?
You keep saying that they're going to give up on the whole thing. No, I'm saying there's much more to it. There's at least two other things. One is the government will have more of their money. Two, they're going to invest in other things like tax-free municipal bonds. They're not going to give up on the whole thing. I'm just saying there are incentives there that we're giving these people. It's not just one result. it's many results, but they all tend to take people away from investing in these big enterprises.
Maybe. I mean, I think it's all very debatable as to how much it actually impacts the overall economy. I think when we're talking about like a 90% tax bracket, then yeah, I would agree with you. There's probably going to be a lot of demotivation that's happening there. But when we're going from a 40 to a 50, or we're not even at 40, what are we at, 35? Is that the high tax rate right now? 37, 35 or 37?
39, I can't remember.
Yeah, somewhere in there. When we're bumping it up, the 5%, let's say, which is probably, I think that was what the decrease was. I think we were at 42 before, and we dropped down to 30, 37 or something. And there was a big change that happened, but everyone's afraid of going the other direction. And another thing that people talk about is, well, they'll leave the country, they'll go to a country that has more favorable tax circumstances. Well, my response is let them go. And the reason why is because where are they going to go? They're going to go to Panama. They're going to go to the Philippines. They're going to go to, countries that have maybe that they can get a lot for less money. But those countries don't have the same standard of living that they're accustomed to. They're not going to go to Europe because Europe has higher taxes than we have here. The only ones I can think of that left recently was when Steven Seagal went to Russia. Because he didn't like the taxes that he was going. Good, let him go. Because there's not that many that are going to go there, and those that are not. They're not really benefiting they're not benefiting us, and so we don't need them. And there's plenty that will stay because of all the other benefits of living in a high tax society.
Yeah, I don't know. I'm not quite sure the argument. Like, they don't necessarily have to move there. They can just headquarter their company in Ireland, for example.
Yeah, I mean, when you talk corporate tax, it's a little different. But in the U.S., the U.S. is one of the only countries where you get taxed based on your nationality, not on where you live.
Yeah, you're talking about personal income tax, but once again, there's more incentives that we're talking about to run more of your business through a corporate entity. I mean, these are all incentives. I'm not saying it's right or wrong or that it's going to work perfectly, but we're creating incentives. And I totally agree that it's difficult to say, well, listen, if we go from 50 to 45 or 45 to 40 or whatever, I don't know how much that will change things, but we should at least concede the fact, and I think that's all you and I need to do today, is concede the fact that there are going to be incentives involved in all of this. And people got upset recently about, hey, well, why is Amazon paying so little in taxes? They made like $11 billion in profit and paid no taxes or something. And a lot of that, I would imagine, had to do with carry forward losses, because for so many years they had lost so much money. And they had put at risk so much money and continued to invest in a company that was losing money. And then R&D, which our tax experts in this country have decided that research and development is very important. So they said, well, listen, we want to incentivize people to invest in R&D, and they get some tax breaks for doing it. We want to incentivize people for investing in capital equipment, and so there's very generous tax breaks involved for people they're huge depreciation tax breaks. You can take accelerated depreciation. I've seen real estate investments where you can be turning a really good profit, and then the accelerated depreciation allows you to call it a loss that year because you take that accelerated depreciation. Now, we can say that's right or wrong, but there's incentives. Somebody in Congress, whether because they were told by somebody wealthy or some lobbyist or some other reason, they decided, yeah, I think that's a good thing. We need some affordable housing in this country. How do we go about doing it? We incentivize people to invest in real estate. How do we do that? We give them tax benefits for doing it. They're still going to pay their taxes at some point where we postpone it. And that's all I wanted to bring up in this second part of the discussion was there are unintended consequences and huge incentives at play when we talk about taxing in different ways. And we've talked about some of them. We can quibble about, well, listen, it doesn't, I brought up from the first, listen, there's diminishing returns. If you go from 12% to 11%, probably not a big difference. You may be right that if you go from 40% to 35%, not that big of a difference. I don't know. But what you are left with is there is still 5% that's now going into the government instead of going into Elon Musk building Tesla or Solar City or the Boring Company. I mean, and I'm not saying that's right or wrong. I'm just saying that is a consequence of all of these things that we're doing. And by the way, one other unintended consequence is the higher the tax rate, especially on wealthy people, the more incentive they have to go to government and try to affect change and take control. What I mean by that is if the tax rate on wealthy people was 10%, they're like, I think they'd be more inclined to just pay it. Then if it were 90%, then they're going to say, hey, let's go to Congress and find some loopholes, some changes that we can make and convince Congress that, hey, these are good ideas because they're going to result in a stronger economy, a stronger housing market, whatever, what have you. Those are going to have effects. And we can't deny that. We can't deny that there's going to be incentives. You're going to incentivize those wealthy people to go and send lobbyists to Congress. I'm not saying we can't raise the rates because they're just going to lower them. I'm just saying that's going to be an effect, and we should at least accept that fact.
Well, I mean, no one's ever there. It's very few people that are willing to say, yes, I'm now paying enough taxes. I'm going to stop trying to pay less. There's always a motivation to try and keep more of your money, or to try and make more money, or to try and work the system to your advantage. It was always funny during the political debates when people get mad at someone like Mitt Romney saying, well, how dare you take advantage of all the tax advantages that you can? And say, well, why wouldn't he? You're going to say, you're saying I should only pay this little taxes, but wait a second, I want to pay more. Let me pay more taxes than I have to. I mean, it was such a stupid argument that people were making. And I think people will always do that. They'll always try and figure out a way to pay less, just like you go to an accountant to try and work the system a little bit more. If you have the ability to go and actually create some of those rules, of course you're going to say, let's see if we can work this a little more in my favor. And I'm going to give you some reasons as to why, because I'm going to build the economy. Me and my people, we're going to start to buy more stuff, and we're going to start to invest more in some companies. Yeah, people are always going to do that. And you know what? There's always going to be people that'll be unhappy. And in fact, when you're talking about taxation, I guarantee you, no one will ever be happy with the amount of money that they're paying in taxes.
Yeah. So, I mean, I think we agree there are incentives. We can discuss more about what we think they are, but maybe we should move on to the third topic, which was the ideal tax system.
I would love to. We only have, we're about 6 minutes left. Do you want to push this off until next week?
Okay, we can do that.
Yeah, because otherwise we end up trying to rush it in, and then we're both trying to get the last word in. So let's give it the time it deserves.
Okay.
All right. So we're going to talk about the ideal tax system. Is that what it's going to be?
Yeah, I think maybe just I wouldn't say ideal in the sense that I have the perfect structure, but we can talk about the things that I think we should look for in an ideal system, or the things that I think would affect the biggest change to give us more of what I'm looking for, and maybe you can think the same way about it. Like, I won't say it should be exactly, it should all be sales tax and it should be this rate or anything like that, but we can talk in broad terms about the types of things that we want to incentivize and the types of things that we want to avoid.
I'm down with that. Let's do it. All right. So we'll hit it on next week. Okay. One of the few times where we've had the conversation and we're not trying to rush at the very end. So this feels a little more spacious, a little more relaxed.
Yeah.
All right, Colin. Talk to you in a week.
Okay, sounds good.
All right. We hope you learned something in this episode of Brother versus Brother, a podcast about difficult conversations. We also hope that you enjoyed it enough to subscribe to the podcast. You can help us by spreading the word. Share this episode on your favorite social media so that others will have an opportunity to experience it as well. You can also support us by donating through Patreon. This information and more can be found on our website, broconvo.com, and on our various social media accounts. Thank you.